Welcome to the Corporate Treasury 101 podcast. This is the first part of our full conversation with Alex Griffiths, where we discuss what is a credit rating and the credit rating process at Fitch Ratings. Alex Griffiths is a managing director and head of EMEA Corporate Ratings at Fitch Ratings. Fitch Ratings is a credit rating agency that rates the viability of investments relative to the likelihood of default. Fitch is one of the top 3 credit rating agencies internationally known, along with Moody's and Standard & Poor's. In the episode of today, expect to learn what is a credit rating, how credit rating processes are broken down, how can treasury professionals effectively contribute to the credit rating process, different rating scales used by Fitch Ratings, and, like always, much more. I really loved our conversation with Alex. He truly is passionate about his topic and extremely fast on answering even our most intricate questions. And we truly hope you will enjoy the episode. If that is the case, and when you are thinking about how you found out about our podcast, chances are that it was through word of mouth, social media, or a recommendation from your favorite podcast platform. And this is our only request to you. The only way we can get more and more amazing guests like Alex and get more people to learn about Treasury is thanks to you. So if you enjoy what you hear and maybe learn a thing or two, please consider following the show, leaving a review, or sharing this episode to help others discover it too. With all that being said, please welcome Alex Griffiths.
Alex, thanks so much for joining. Great to have you on. Can you get us started by telling us what a credit rating actually is?
Absolutely. It's important to understand the definitions because it is a little bit technical. And knowing what you're dealing with is the first part of understanding how credit ratings move, how they can be used, all that sort of stuff. So I'll read a definition here because it's important to get this right. So credit ratings are assigned to issuers or obligations that are an opinion on the ability of an entity or instrument to meet financial commitments, such as interest or principal on bonds, debt preferred dividends, insurance claims, or counterparty obligations in accordance with the terms of the investment. So there are important parts of that. I mean, one, they're an opinion. There's no absolute right or wrong here. We're effectively trying to forecast the future. Secondly, it's about the ability of an entity or instrument to meet financial commitments. So, I look at corporates. It's all about can the corporate repay its debt, essentially. We normally focus on bonds and loans as those financial commitments. But sometimes when we're thinking about an entity, our considerations can go further to things like leases, which can sometimes, if they're not honoured, lead to a default being recognised. And then there's the final point, which is in accordance with the terms of the investment. So, we're trying to understand here, is a company doing what it said it would do in the first instance? You get situations where sometimes payments can be deferred. If that's in line with the original terms of the document, that's unlikely to trigger a default. But if it's something where it even looks fairly plain vanilla, everybody agrees to it, but it's not in accordance with the terms of the investment, that can start to look like it might trigger some kind of default action on our basis.
So how are those used? Why are those important? How are they used in the market? And what do people, specifically treasurers perhaps, what's the importance to treasurer for ratings?
So, essentially, one of the things you're doing as a treasurer, and I'm not a treasurer, but I understand the job a bit. One of the things you're trying to do is diversify funding sources, make sure that you've got access to funding from lots of different pools of capital. Now, there are some pools of capital out there, and they're pretty large pools of capital out there, that will only be able to invest in a bond if it's got a credit rating. So, typically what we see are, if we have, say, a company that's been fairly well banked in its local market, maybe there's a local bond market that doesn't require credit ratings, it's got maybe a local bond, but they're trying to build a really big plant. They need a lot more money, and there they have to seek foreign investors. And usually those investors will want a credit rating. They need it for inclusion in indices, for example, where a lot of money is invested in fixed income indices, and some of that eligibility criteria revolves around having a credit rating. Also, a lot of institutional investors in certain funds can't invest in things that aren't rated.
The market well-being, Alex, is highly based on trust, right?
Yeah.
Would you say that the credit ratings help building that trust between the different stakeholders? Because if we were to look at all the different entities you have out there, financial institutions and so on, even as an outstanding corporate treasury, it might be a bit tricky sometimes to know who does what. So would credit ratings help on that aspect?
Absolutely. I mean, that's why they exist. So if you're a third-party investor thinking about investing in a bond, you don't have anybody's unbiased in the mix unless the credit rating agencies are involved. So you have the bank who is trying to essentially offload the debt into the market, working for their clients. You've got the issuer that obviously wants you to participate in the transaction. What credit ratings offer is a third-party unbiased opinion on that. So that's why the markets value them. Why they're often required by different parties. I mean, the other thing they can do sometimes is deal with an asymmetry of information. So, certainly unlike third-party investors, we often get our party confidential information that isn't shared with the market. So we might see more detailed forecasts, for example. That is included in our credit rating. We keep the information confidential, but reflect that in the rating. So often it's also a way of issuers to share a bit more and get the credit for a bit more with a party they know is firmly committed to confidentiality. The third parties investing in it get the benefit of that, but the information is kept within a sealed wall.
So overall, I mean, the purpose of these ratings is to have a third party which is unbiased in the transaction to give, let's say, objective opinion on the risk level towards investing in certain companies, or for borrowers to lend.
It's all about credit risk. So it's very simplest. It's how likely am I to get my money back? We don't express these things in default probabilities. I think a lot of people would find it easier if we did, but what we're very aware of is the financial conditions can vary an awful lot, and that can vary overall default probabilities. So, the way that I think about it in very simple terms is, if you imagine a ship on the sea, and the ship is the thing that we're rating, we're telling you how strong the ship is compared to other ships. We're not trying to forecast what the sea's going to do. So what we get is this relative ranking where we say that a AA bond rating should be, if we look at it on the aggregate, we should see a marked difference between the default rate historically for a AA bond rating versus, say, a triple B or a single B. And when we look at our default statistics, that's where we get to.
Is there an overlap with the insurance industry in some way?
Insurers are big buyers of bonds, but and there are various things like credit default swaps, and there are some. I suppose there are some links, but it's probably not directly, I'd have said. It's not we're doing credit ratings. We tend to just we're focused essentially on the company and what it's doing, less so, in fact, on the buyers usually.
I bring it up because you made the ship analogy, and that was kind of the origin of the insurance industry, wasn't from the shipping. And it was, again, assessing.
Stop using that analogy.
No, because it's all about assessing risk, right? At the end of the day, which I guess insurers are there to profit off of their assessment and their understanding of risk in the market in whatever they're insuring, likelihood of getting the money back or not, or having to do a payout, or not, and then assigning your fee accordingly. But I guess you're not trying to buy into that risk. You're just publishing it, I guess, in a way. Yeah. And you have the trust of approval from the market to, if, for example, Fitch gave a certain credit rating, then that means something to the market, enables trust.
That's the important thing if you're in this market, is building up a reputation over time of being unbiased, doing the right thing. We're only of value if the investors that look at bonds genuinely believe that we are independent. If they think that we are not, then we're of no value. So we've built up our reputation over decades by demonstrably taking an independent view.
what's the actual process of creating that credit rating? I guess each rating agency is slightly different. You have your own way. How do you guys do it at Fitch?
Yes, they're all slightly different. I wouldn't want to speak for my competitors. They're sort of different, but and I can talk corporate credit. There's only so many variables in corporate credit, so this will give you a very very simple overview. So the way we look at it is there's really two aspects that we focus on. I mean, the first is the qualitative side of things, which is all about understanding the business, and then there's the quantitative side of things, which is once you understand that business, working out some metrics you can use to judge it to try and align it a bit more to a rating category. So the way that we focus at Fitch, and I think we tend to do this a bit more zealously than some of our competitors potentially, is we try and really understand that business and use that to forecast results going forward. So when I say we try and understand the business, we do that via over 50 what we call navigators. So for each sector you're in, we have a sort of a visual aid or a criteria that we set out, which talks about what sort of characteristics are associated with a double A in this sector, a single A in this sector, a triple B in this sector, and those will have qualitative and quantitative aspects associated with them. So a simple example of a qualitative aspect is scale. Scale is on pretty much every navigator, and scale is important because you have not just potentially a classic economies of scale. What it typically means is you're more diverse. So if you're diversified across different countries, if there's a problem in one country, the rest of them may well be doing okay. You'll usually be diversified across different business lines as well. And what that means is if one business line is not doing very well, the rest are unlikely to go wrong at the same time. But it also gives you leverage over your borrowers. So if you're a small borrower, then it's potentially easier for the bank to turn around and say, no, you need to pay us back now. We don't really care. If you're a gigantic borrower, actually it becomes more of a negotiation. So there's more at stake from both sides. It's more of an equal party. So scale is one of the things that runs through a lot of these navigators, but then it can get very, very detailed. So things like reserve life in oil and gas, things that if you were reading any analyst coverage on a sector, you would see and they would use to differentiate between businesses. But I'm not going to go through every single of those 50 navigators, but they are there. They're all available on the website. And if you're really interested in working out how would Fitch think about your business and your sector, have a look at those navigators. They're quite comprehensive. So once we've done the qualitative side, we then think about trying to sort of come up with an overall risk from the qualitative side. And if you're thinking about this in very simple terms, what we're trying to do is work out how stable the revenues are, or how stable the cash flows coming in are really. So you think about revenues, think about costs. That generates an amount of cash that you have to play with. You can obviously put some of that into CapEx, and some of that will be discretionary. You can start to think about how stable and predictable a position is this. If it's less stable, we'll be looking for higher margins typically, so that when things are going badly, you're not in negative territory. But essentially assessing how solid is that cash flow that you'll use to underlie or to pay your debt. And what you then do is you say, okay, if that is a really stable, steady cash flow for a certain rating, you can take on more debt. Because usually there will be less variability, and there'll be no point at which, or there'll be less likelihood of there being a point at which you can't make those debt repayments. If you've got a very volatile business for a particular rating, you'll have a lower leverage allowance. So you'll have maybe 1 times at investment grade if you're very, very volatile. So, and we look at this in terms of cash flows. So much as we're trying to look at the generation of cash on the qualitative side, when we look at our leverage metrics, I mean, they're obviously classic sort of business school type leverage would be debt to equity. We find that less useful from a corporate basis because debt to equity, the equity component depends a lot on what choices you've made in the past. If you've grown organically or grown by M&A, you'll have generated balance sheet assets of the M&A, which you wouldn't do if you grew organically. And therefore, you could end up with a very skewed set of metrics for actually a very similar sort of company. So we tend to look at how much cash you're generating and play that forward to see what your ability to pay down your debt is. So you put the qualitative and the quantitative together and you come up with the overall rating. Two other points to mention. One is, I mentioned understanding the business is important to us. The main reason that is, well, obviously the qualitative is a big part of this, but it also allows us to forecast. So it allows us to push forward with our thoughts on what the credit metrics might be. So what we often see are companies in a state of flux. I mean, there are very few circumstances we see where a company is completely dead flat with similar credit metrics. This is a real world, particularly the last 4 or 5 years. Businesses have been up and down quite a lot. What we don't do is simply take last year's metrics, say, okay, that's not appropriate anymore, we'll mark you up or down. We're aiming for an element of stability to reflect the fundamental of the business, and we do that using our forecasts. We I suppose, I won't say perfected, but we spent a lot of time working on this during the financial crisis of 2008-9. We trust our forecasts, we spend a lot of time doing them, and we use them to make rating decisions. So we're not backward looking, we are very, very much forward looking. What does that mean? I mean, a good example of that is if we look to the pandemic, we were essentially, it was one of those, it was a terrifying situation if you're in our position, if you like, because suddenly it's a bit like someone's got a deck of cards and thrown them up in the air. All that you thought you knew has just changed. But what we were able to do was say, okay, this is judging by what we understand about this and what's happening with lockdowns, you can fairly quickly say, okay, it's the stuff that needs face-to-face contact that's going to be impacted. And you then think about which of those companies might be more or less impacted based on your initial judgment. And what we did was we did a sort of triage, first of all, rank things in terms of looking at how much risk were they and also what's their headroom within the rating. And we triaged and we brought them to committee. When we were going to committee, what we looked at was firstly, liquidity. So this is in early 2020. Can this company get through to the end of the year? But secondly, what do we think it's going to look like at the end of 2021? So, looking really the best part of 2 years out to whether it could get through and recover to something which looks appropriate for its credit rating in terms of its credit metric, its leverage, its coverage. What that meant was we didn't downgrade as many companies as we might have done if we were purely knee-jerking. And we've had a reasonable amount of praise in the market of that, but also, when I look at our performance, we've also not seen a vast number of upgrades from it was over 100, but comparison to some of our competitors, that was quite a limited number of downgrades. We haven't seen many upgrades either, which suggests that what we did do was the correct call, in that when we took things down, they did actually stay down for quite a while. And obviously, the current economic circumstances mean that not that many of them have gone back up again.
Lots of nuggets here, Alex. To come back to one of you mentioned. So of course, we're not going to get into the 50 navigators, but I'm a bit interested because you mentioned the visual aids. What is your benchmark then? When you look at an industry, to come back to one of your first points, like what sorts of characteristics are associated with any of the ratings, AA, BBB, whatever? What's your benchmark then? How do you determine that?
I suppose we look at, it's all slightly circular in that we also been doing it for quite a while. So we actually put together these navigators by looking at where the ratings originally sat and what characteristics we'd seen in our experience making a positive difference. So, what we have is a track record going back over 20 years showing that our ratings effectively work. And we put these navigators in place something like a decade ago. So we were very much using our experience, but it's these aren't things which are, I suppose, magical or not common sense. So scale, is one. Are there barriers to entry? The regulation stable and favorable? If you're an oil company, again, I'll go back to that example. Do you have a lot of reserves in the ground, or are you about to run out of oil to extract? So all of these characteristics, they tend to make sense, particularly if you know the industry. And what you then have to do is obviously start calibrating those. And the way that we do that is we say, okay, we've got a list of ratings already, and we know that broadly how we've got here works. What do we associate with a double A company in terms of its reserves, or single A company in terms of the regulatory environment you've got to have to reach that? You map the characteristics onto a sort of an already known or already opinioned quantity. And then you look at it and say, does this make sense? And obviously we've been working with these for 10 years or so since we did the navigators, and it still seems to be working. So there's evidence that it's all making sense to us.
Absolutely. What I love about what you're explaining, Alex, is that, so I think most of the people got a taste of what a rating is with the subprime crisis, obviously. When you get into the corporate treasury world, obviously you see those more and more, but you can easily think that it's mostly a financial statement analysis that is done.
Yeah.
But what you explain is that that's absolutely not the case. You look at the business. So in terms of, we're going to come to it, but in terms of resources and people that are working with you, they're not only finance analysts, those are also business analysts and people who will be able to say, okay, when you mention this, is there enough oil in the ground? Is there, like, what are the circumstances and the context in which this industry evolves and so on? That's super interesting.
Yeah, I mean, absolutely. I tend to think about, all of our people are trained to read and analyze accounts, but I tend to think about that as reading. I mean, it's a bit like going to study and not being able to read the language you're studying. It's kind of the basics. Understanding how a set of financials works, how a bond indenture works is important, but understanding how the business works. And we get a wonderful variety of things, and that's part of the joy of doing this job, is that you see all sorts of different business models and issuers, and a lot of them are really clever. So what we get is a lot of people that have an interest in working out how the world works and how that sausage I saw in the supermarket on a hot day when everybody's barbecuing managed to make its way there in such quantities. That's the sort of thing that's fascinating to the people that work with us.
That's really, really cool. Another point you mentioned was M&A, when you were especially touching upon this debt to equity ratio, right? My understanding was that companies that are renowned to go through a phase of merger and acquisitions usually tend to have a lower credit rating because there is a bit of uncertainty associated to it. Why is that? Is my perception correct, first of all? If so, why is that? And back to the growth aspect you mentioned, because M&A enables growth, maybe less in a steady way, but growth for sure. So how is the M&A aspect impacting the credit rating? Back to those, how do you actually rate companies?
Yeah, so there's a few things that happen when you get M&A. One is typically, and obviously there is failed M&A and there are problems with M&A sometimes, but the business profile or the operations, so the operational profile will improve. So, we were saying scale diversification is positive. If you do M&A, and let's assume you're not crazy, right? You've thought about it, you're doing it for a good reason. You'll be strengthening your product portfolio or diversifying into an adjacency, and you'll be able to realize some synergies from that. So the process of doing M&A in terms of getting something else attached to your business is generally positive. There's the question of how much are you paying for it. So if you're paying a large amount of cash for something that maybe doesn't have that many synergies, that's a judgmental point. And we do occasionally see M&A that we don't think is brilliant, but for the most part, the people doing it are pretty sensible, and it is positive for the operational profile of the business. If we look then at the financial profile, it gets a bit trickier. So, obviously there are a few ways to pay for M&A. One is with your own equity, and if that happens, that's certainly for the credit rating generally the most favorable because there's no additional debt there. Usually there's either a mixture of debt and equity, or there is pure debt. And that's where it starts to become a little bit complicated, because then it is really a trade-off between how much does the M&A enhance your operational profile versus how much additional debt do you take on? How much does that increase risk? So, we have companies that do, you might call, single big ticket M&A. You get, giant investment grade companies that will buy a competitor, and that will be hugely strategically important, but it tends to be incredibly expensive. So you might see if you've got a, say, 2.5 times leverage threshold for somebody, it'll shoot up to 4. and might stay there for a couple of years. Now, that's where the forecasting gets interesting, because we then say, okay, we know that this is business enhancing, or we think this is business enhancing. Can we wait for the leverage to come down? And if we are comfortable enough that, over a reasonable period, call it 1 to 2 years, the additional cash flow is being generated and the commitment of management is such that we can reasonably expect that to come within its tolerance again, the chances are we'll leave the rating where it is. So we will try not to move if we believe that that is achievable. But obviously that's a pretty big judgment call, and we don't always agree with management. They tend to believe in themselves, and sometimes, unfortunately, we don't.
Makes sense. Super cool. That makes a lot of sense. And so when we look at other aspects that the company can influence the credit rating on, how does the role of a corporate treasury department factor into this whole process?
I mean, treasurers end up usually being the people we speak to the most in these processes. It doesn't have to be the case, but it seems to be just the way of things that treasurers are tasked with dealing with capital markets, raising debt, and therefore the credit rating agencies sort of come under them. We have them generally as our first point of contact. They'll often pull in people like the investor relations department or potentially the CFO. But for most relationships, it's the treasury team that we are most often speaking to. What does that mean in terms of the interaction? I mean, the person in the treasury team is really the conduit for the rest of the organization. Because, as you've heard, we will be trying to understand not just about finance and strategy and stuff the treasurer spends all day thinking about, but also about the company, its merits, its business model. So typically the treasurer is not going to be able to answer all of that at once. So it's very much about the treasurer bringing in the information that they think we will need, or we'll usually give questions. So it's a question and answer those questions, but very much being that sort of conduit to the rest of the organization.
Super clear. So if I'm a treasurer then, Alex, what can I do proactively to be able to improve that credit rating or to put my company in the best position for that?
I suppose that's the thing, the obvious thing that the treasurer can do is have less debt, typically. That tends to help. Other than fundamentals like what is the structure of your balance sheet, how strong is your business, there's not much that's non-real that a treasurer can do. I mean, what we look for in sort of treasury functions and funding is it's the quantum of debt, but also the term structure, the sources of finance. Are you just reliant on a local banking relationship, or do you have lots of other options? So we'll think about liquidity, and that's obviously the key thing that a treasurer can influence. I mean, hopefully not just for the sake of the credit rating. Hopefully that's part of their job. But when we look across different treasuries, then the structure of the debt is an important part of what we do, and that's very much within the purview of the treasurer. Other than that, it's really, I suppose, it's a question of just understanding what will facilitate the process and make it easier, and I suppose developing a bit of trust. The good relationships that we see are ones where we are brought inside. We're not surprised. If there's a big M&A, often we get told about it a few days in advance. We can think about it. If there's a problem, we get told about it early, and it's managed proactively. So, it's the same sort of skills that you'd see a CFO using with the capital markets. It's finding a problem and discussing it with a relationship of trust with your rating agency. I mean, the worst things that we find in these relationships, which inevitably tend not to help the treasurer, are where there are surprises. We feel like that something is being kept away from us. If I look across all these relationships, developing that relationship of trust is really important for us. But it's also where we have the best relationships with treasurers.
I'm guessing only companies of a certain size need to start having that close of a relationship with you, right? Like your normal SME isn't. At what size does a company have to start? At what size does the treasurer of a company have to start worrying about keeping you guys in the loop with all of these decisions so proactively?
Well, I mean, we tend not to look at small companies. So essentially, if you're big enough to be rated, then we'd expect those discussions to be being had. Yeah, we don't differentiate between credit ratings. We don't differentiate, the amount of work we do. The process takes often a similar amount of time. And sometimes, there's many issues with smaller companies as larger companies. So, I wouldn't say there was any difference in those relationships. And obviously, if you're a treasurer with 50 billion of debt to raise, you probably take it as seriously as a treasurer with $1 billion of debt to raise because it's still your company. A relationship of trust is important on both sides.
Super clear. So could you go back a little bit to the credit scale that you've mentioned a couple of times, Alex? So you mentioned like AAA, AA, etc. I think it goes all the way down to D, right? Can you just give us a brief overview and how that works?
Absolutely. So there are a few credit ratings that people talk about. Usually, the credit rating is what we call the issuer default rating. Technically, in fact, if we're being really technical, we call it the long-term foreign currency issuer default rating. So when people talk about the rating, that's what they're talking about. So what issuer default means, essentially, we're talking about the chances of the company defaulting. So fairly clear what that means. That's all about likely to default. Foreign currency means we're thinking about obligations that can be traded cross-border. So it's not something where there's potentially transfer and convertibility risks. So they're usually in currencies like dollars, euros, etc. And long-term means we're looking across a longer horizon than short-term ratings, which are slightly different, which are money market related typically. So this is a few years out effectively. Within that, what we have is AAA to D scale. So you have it split AAA to BBB minus, and within most of the categories, AAA, AA, single A, BBB, you have plus and minus modifiers. So BBB minus is at the lower end of that band, BBB plus is at the top end of that band. There is a cutoff between BBB minus and everything below it, which is investment grade versus sub-investment grade. The sub-investment grade is traditionally been associated with far riskier debt. I mean, in the 1980s, they used to be called junk bonds in the US. What we've seen really in the last 10, 15 years is that sub-investment grade part of the market. So these are companies which are rated in the double B range, single B range, but still performing businesses. That part of the market has expanded quite a lot. So, that junk sort of prefix that you used to have starts to feel a little bit pejorative. There are a lot of very good companies issuing at that scale. They're just a little bit smaller than the companies that at investment grade or have a little bit more leverage. So we see a lot of LBOs, for example, with ratings in the single B territory as part of a corporate strategy to act as part of, say, a private equity group or what have you. But putting debt in there is part of what they're doing. But that is part of a thought out strategy, and not necessarily because the business is in a difficult situation. And then below that, you've got sort of the more distressed territory. So B minus and above are essentially performing obligations. Triple C plus, so there's the triple C range, double C and single C, which is, there is a very real default risk present there, and more so as you go down the scale. And then there's restricted default and default, which is obviously some form of defaults happening. The D rating itself is essentially something like a liquidation.
That's interesting you touched on. Like, not every company is aiming to always aim for AAA.
Absolutely. And a lot of so we work with companies all over the world in developed markets, emerging markets. And there are concerns, particularly once you get into emerging markets, around what the rating can get to as a maximum. So, you might be the best company in a certain country, and you think you should be AAA. Well, actually, your country's rating is single B. So, are you really that much better than the government? Well, essentially, probably not. What we do there sometimes, if there are large financial markets, and we see this in some of the emerging markets where you have, say, a burgeoning pension market in a country that's rated maybe double B minus or B plus or something, it's not going to be much help to people investing their pension if they know that a whole bunch of stuff is B plus. Everything's B plus in the country. So it's not going to help them differentiate. So what we do is we have essentially sort of expanded scale, so we call national ratings for some of those countries. And what that's designed to do is to help people decide between the different investments that on an international scale would be a B plus, but we can start to differentiate within that B plus by assigning something which is, let's say, a AA national or AAA national scale. And that's a full rating scale. It just starts, if you were to map it to investment grade, it starts with B plus equaling AAA. So you get that more granularity, so it can become a bit more helpful.
So you like scale it according to country, almost.
Exactly.
And do you then do the exact same business analysis, quantitative and qualitative, of the government and the local, of the market as a whole?
So that's not my area. So I'm sure if you get a sovereign analyst on, they can give you a separate hour on sovereign ratings. Yeah, but they look at some of the similar things like governance, like financial profile, and they come up with ratings. It's the same scale they use.
But Fitch or independent companies like Fitch, you guys issue a sovereign rating, like a government rating, and then business ratings within that. And then you try and...
Yeah, so we cover most of I think all of the relevant or sort of capital market available sectors. So sovereigns is a big part of that. We cover most of the world's sovereigns. Obviously, we do financial institutions as well, structured finance, public finance. So yeah, most of what you might see in a large bond market, Fitch will do in one part of the business or other. I look after the I suppose the simple non-financial corporate.
Linking back to this, indeed, so the ratings we are talking about mostly here. What's the significance of a credit rating for a company in terms of actual impact? Like what is at stake for a company when it comes to the credit rating?
The main thing is the price of the debt. So obviously, if you're potentially loaning somebody money, then you're not just making a yes/no decision. You're making a decision about how much, what's the interest rate you're going to get on that debt, and to an extent, what terms and conditions are you going to demand from the borrower. So if you're trying to work out what the credit risk is, then independent opinions like Fitch's are obviously very important. And one of the things that investors use when they're trying to come up with that pricing view. So credit ratings mainly have an impact on pricing, but also there are other ways they're used. So you can use them to look at your supply chain, for example, just look at counterparty risk. That's not what they're designed for, but some people do use them as a proxy. Some people like to use them as a sort of benchmark for their own internal governance. So particularly we see this with groups with private ownership. They don't have the discipline of the capital markets. They need some sort of third party. So actually getting a independent view on what their creditworthiness is very valuable to them.
Very interesting. Yeah. So also for the private companies, I didn't even think of that. Makes lots of sense. And so to state a bit the obvious, Alex, because now that we have the main reason and the main impact, what are the consequences of an upgrade in credit rating? And obviously, from an opposite standpoint, what about the downgrade? Like, what's the impact for a company?
It's slightly perverse in the sense that if there's an upgrade, it may well not do anything immediately. What it means is the next bond you issue, you may be able to negotiate better pricing. A downgrade similarly might not do anything immediately, because what we're talking about mainly here is fixed income investments. So the interest rate is fixed at the start of the period, and it continues until the bond needs to be repaid. It's only when you need to refinance that actually the rating has an impact on the borrower. The lenders will potentially be marking the bond to market, so it will have an impact on them and on the markets, and that will obviously affect their willingness to lend again in the future. And I suppose the second point of this is a lot of it is not just about the price, it's also about refinancing. We've seen this in the current market where refinancing is no longer a given, it's more of a question mark about whether companies can get a bond away. If they're higher risk, if they're not known by the market, there have been windows where it's been very, very hard to just get a deal done. Obviously, negative news on the rating side can make that a bit harder.
Because I had in mind, obviously, it will cost more money to borrow money. But from a lender standpoint, if you are a public company and you resell the bonds afterwards, it might be trickier for you to resell it, even though you might have had better interest rates on your investment.
So in theory, if the pricing hasn't changed in the interim, so if you're being fairly compensated for the risk, so it was downgraded, then you bought the bond. The market should, in theory, all work out. If you bought a bond at 5% and then it gets downgraded,